Hey guys, recently I posted a video showing you the process that I go through when I'm considering a bear put spread. Um, I'll link that video in the description below, but in this video I would like to do the opposite. So I'll walk you through a call spread in this case. And you may already know this that I keep my trading very simple. So the only two trade structures that I use are are a call spread when I'm bullish in the markets or a put spread when I'm bearish in the markets. So I don't indulge in any other complicated zero DTE strategies, butterflies, iron corner, none of that. So I keep it very simple: bullish or bearish, call spread when I'm bullish, put spread when I'm bearish. So I have already walked you through the process for the put spread earlier. In this video, I'll walk you through the thought process that I go through when considering a call spread. Now, to walk you through that, I will go through a trade alert that I recently posted. It was on gold, actually GLD, which is an ETF. For anybody who is seeing this for the first time, this is my Discord server. So you may know this that I run an educational group on my website tradingextremes.com, and anybody who finds value in my book or my trading style can join our server for a monthly subscription fee. And what I do is I take trades live in my real accounts based on the methods that I've described in my book. And then I mentor people. They can ask me questions, they can learn from why am I taking the trades, what am I doing with the trades after I open it, all that stuff. So on my Discord server, I keep it very simple. So on the left side, you can see there's some information section here on the top. Then there is this section called trade related. So every morning I'll post an announcement um, showing you, talking about how I plan to tackle each day, because the stock market is a very fluid environment. So every morning you have to come up with a trading plan on how you're going to deal with the markets on that day. So in the announcement channel, I post what my trading plan is for that day. Then I have trade alerts where I actually post um, trades that I'm taking in my own account after they get filled. And then I have a market outlook channel where I post a weekly market outlook. So what, based on what happened last week, what do I see happening next week? I also cover things like important macroeconomic data that might be coming out, any geopolitical um, happenings around the world that may affect the US stock market, stuff like that. And of course, I have historical trades where you can see all the trades that I've taken going back to when I started this group in 2020. Okay, so going back to this particular example I'm talking about, it was a bull call spread. This is how a trade alert typically looks like. So I post these trade alerts like within seconds of me getting filled on a trade. So symbol is gold, GLD. Now the trade structure is 171, 172 call spread. If you have traded vertical spreads, this should be very obvious to you what I'm doing here. So only the difference is most people for some reason do credit spreads because that's the strategy that's been popularized on the internet. But I do something slightly different. I do debit spread. I don't do credit spread, and I've gone into detail in my book why I prefer debit spread, because they double my money with every winning trade. Credit spread, the way they are usually done is um, you you do a high probability trade. Now with high probability comes high risk, so you could win 7 out of 10 trades, but the 3 trades that you lose will wipe out your last seven, the profits in the last 7 trades. So you need a solid trade management plan in place for you to be successful with that. But anyway, so I prefer debit spreads because they double my money, they grow my account really fast once I get a winning streak. And the structure that I'm showing you here is 171, 172 call spread. All that means is I am buying a 171 call in GLD and I'm selling a 172 call at the same time. That constructs my vertical spread. Now, the cool thing about debit spreads or at the money debit spreads is if you notice in the trade alert, I've also mentioned price at time of trade. It says 171.2. That means the price is right in the middle of my strikes. So it's slightly higher than 171, which is my long strike, and slightly lower than 172, which is my short strike. And when that happens, you can get into a spread for half of the cost, half of the width of the strikes. So in this case, the width of the spread is $1. Why? Because I'm selling a 172 call and I'm buying a 171 call. So 172 minus 171 is $1. That's my width of the spread. And the cost to me is 50 cents. So divide $1 by half by 2. That gives you 50 cents. So the math is really simple. So I've also mentioned here, cost is $50 and potential profit is $50. And as I mentioned earlier, that when I succeed with these spreads, it literally doubles my money in 20-30 days. So the growth your account can experience is really nice when you get a winning streak. Now, one more thing I've mentioned here is trade type, which is mean reversion. I do several types of trades. So I could take a trade on the mean reversion criteria that I've mentioned in my book, called mean reversion trading using options. And I could take a trade based on general market conditions. So the particular stock that I'm taking a trade on may not even fit mean reversion criteria, but there could be times that I could just take a trade in the same direction markets are going. And that usually happens when there is some kind of a event happening which sends the markets off in a particular direction. An example would be any kind of inflation data that comes out. For example, let's say CPI, the Consumer Price Index, CPI data comes out on Thursday morning pre-market, and the inflation data is, let's pretend the inflation data is tame and it's showing that inflation is coming under control. When that happens, you will usually see that the markets, the futures in the pre-market will start ripping. So markets love that when they hear that the inflation is coming under control, and you will see that the markets just go up like crazy even before the markets open. So when that happens, when futures are giving you an indication that the markets are about to go up today, then it becomes really obvious to you what you need to do. You just need to don't fight the markets, just play along. So that's one of the trades that I take, which is based on broader market conditions. Now, in this particular example, you will see there's this, I have mentioned trade type, which says mean reversion. So this trade is not taken on a broader market move. It's taken based on the mean reversion criteria that I mentioned in my book being satisfied. But since I run this as an educational group, I always give our members food for thought. So I always tell them, why am I taking this trade and why would one not want to take a trade? So I give them both, this conflicting view kind of promotes thinking on behalf of anybody looking at this trade. So in this case, if you see number 4 and number 5, I've mentioned reasons to take the trade. In this case, it's really short. It says full-blown MRT setup. All indicators are a go. And by all indicators, I obviously mean the ones that I've mentioned in my book and I use all the time, like, RSI, DMI, the price candles, Bollinger Bands, Kettler channels, all that stuff. And then I mentioned reasons to avoid. In this case, I've said worth a shot in my opinion. I can't find any reason to avoid this trade because it just looks that good to me. Now, obviously, just because it looks that good to me doesn't mean that it's going to be successful. But in this particular case, that's what I thought about this trade. Now, if you just go just one trade above, which I actually took a bearish trade on Lulu, you will see that I have given a long reason, number 4, reason to avoid. Not your typical mean reversion setup. Almost impossible to find trade setups as 90% of stocks have earnings coming up. Um, Earning season is approaching and good tech earnings is a risk for this trade. So I'll give you reasons why would you want to avoid a trade. And in this case, the reason I've given you is taking this trade based on red hot jobs data and market reaction. So that's one of the examples where I'm taking this on broader market conditions. And I've mentioned this in the trade type too. It says broader market, not mean reversion. So coming back to the gold trade, GLD trade, this is the mean reversion setup. And to explain this further, let's switch to Think or Swim real quick. This is 10/9, October 9th. Okay, so let's do this. Let's pull up Think or Swim, and I'm gonna use Think or Swim's look back feature to go to October 9th and see how gold was looking on that day. Okay, so this is my chart setup, and I have explained in great detail in my book what you are seeing here. So you have the usual indicators that I use. So the green and red lines are Bollinger Bands, the 3 gray lines are Keltner channels, this long blue line that you're seeing, solid blue line, is a 200-day moving average, and the dotted blue line is 50-day moving average. Finally, there are 2 indicators at the bottom. One is called DMI, or Directional Movement Index, and then finally you have RSI, which is Relative Strength Index. So these are the only indicators I use. Now in this case, what I've mentioned is all MRT indicators are a go. So since I've mentioned all indicators are a go, let's take one indicator by one indicator and walk through that. So at the bottom of the chart, you see this RSI indicator, and RSI is very simple to understand. So it has these 2 lines. When RSI drops below this line, which is drawn at the level 30, it means a stock is oversold. All it means is that a stock has experienced a lot of selling pressure recently, and that could mean that it could be at a point where it's about to revert to the mean. Now, one gotcha about RSI is just because a stock is oversold does not mean that the stock will bounce back. And that's where many new traders get caught up with this. They think the stock is oversold, that means it's about to revert back to the mean. They will take opposite trade only to find out the stock continues to drop further. Or you could apply the same thing for a bearish situation too. The stock is overbought. Many new traders think that its stock has gone up too much. It's likely to revert back to the mean, and they will take a bear put spread or any kind of bearish setup, and they'll find to their frustration that the stock just keeps going up. So one thing that you have to be very particular about is, first, let a stock drop into oversold. If you're taking a bullish trade, like in this case, let the stock go into oversold and then wait. And that's one thing that traders have a really hard time, is waiting. Because as traders, we just feel compelled that unless I'm taking a trade every day, I'm not doing enough. But the funny part about trading is that if you just develop the habit of sitting on your hands and not taking a trade when you're not seeing any setups, that's the best thing you can do. So patience is a virtue which comes really in handy while trading. So when a stock drops below that oversold area, now you need to start waiting. You put that stock on your radar, but you don't take any trades. What you need to do is let the stock rise above that oversold area. That's your first indication that this stock is about to revert back to the mean. So in this case, you will see RSI just popped out of the 30 area. Rule number one, check. Now let's go to the second indicator, which is the DMI indicator. Now in this case, so the DMI indicator, you can read about it in my book if you want, or watch a YouTube video. So it's really simple. So it comprises of three components. So there is something called ADX, which is this red line. My colors have switched in this video, so pardon me for that. But the yellow line at the top is called the DI minus. The blue line at the bottom is called DI plus. Now I usually keep the DI plus the color as green and the DI minus as red. So because green usually indicates something is going up and red indicates the markets are going down, so it helps me remember that. But sorry about that, the colors are kind of switched. But when the DI minus line is above DI plus, it indicates that the stock is in a downtrend. And similarly, when the DI plus line is above the DI minus, it indicates the stock is in an uptrend. Now in this case, the DI minus is way above DI plus, and it tells you that the stock is in a strong downtrend. And you can see that because if you look at the price candles at the top, you can just see a bloodbath going on in gold starting on 925. Every day the stock is just dropping non-stop. Now with DMI, the way I use it is when these lines start changing direction. So although DI minus is above DI plus, which indicates a downtrend in place, when these lines start changing direction, that usually points to that the current trend losing steam. And sometimes what you will find is that DI minus will start changing direction, but DI plus doesn't show you anything, or DI plus is changing direction, DI minus doesn't show you anything. So you will find many instances like that. And so this example, this is like that's in the trade alert I've mentioned, it's a perfect MRT setup. This is a textbookish setup where RSI just came out of oversold, DI minus is changing direction, and DI plus is also changing direction. So this is like, every indicator that I'm using is confirming that this stock is about to change its trend. And the final clue that you have is, if you remove all indicators, the easiest thing for you to do is just look at the price candles. And that's, if you don't know anything about indicators, don't worry, price candles tell you a really good story if you start watching them and learning how they work. So in this case, you can clearly see that the GLD just kept dropping, and finally you can see in this area the downward momentum is kind of losing steam. The candle size are small, so there's not much price action. You can see some doji candles appear, DOGI, look that up, what that means. That usually indicates change in direction. And then finally you are actually seeing that the price is moving up. Now one thing to be aware of is that nobody can catch the tops and bottoms in the stock market. It's just not possible. Unless you have a time machine, you will never know if the stock has hit its top or the bottom. So the thing is, you have to wait. You have to wait for confirmation that the trend is actually changing. And by waiting, what you will see is you will always miss the bottom or the top. So in this case, the bottom is here at 168. And then I waited for like a couple of days. So one day here, there's a gap up, and the stock is now at almost 172. So I did miss the bottom, but there's no problem because as a wise man said, waiting for confirmation is your insurance that you are directionally right. So in this case, I did wait for a couple of days for all my indicators to confirm it, for me to visually see that the stock is actually turning around. And that's when I would like to take a trade betting that GLD is going to go up. So the trade that I took in this case is, if you go back to the trade alert, it's a 171, 172 call spread. So if you look, stock is at, this is the price 171.66. So what I did was I bought 171 call, I sold 172 call, and here is the beauty of this trade. If at expiration the stock expires at or above 172, which is this point, I will double my money on this trade. And another nice thing about taking trades on highly liquid stocks, especially ETFs, is that you will find that they have something called $1 white strikes. And I will show you that if I switch to the trade tab, and let's say I'm taking this trade for 25 days out. So I'm going to expand this 3rd November. Actually, let's just do that. Let's find what the expiration is. I have mentioned in the trade alert that the expiration is 11/10. So let's just go to November 10th expiration, and then the stock is trading at 171 point something, right? So I would buy 171 call, I would sell 172 call. This is my spread, 171, 172. And the beauty of this trade is that the cost of the trade is only $50. So in the trade alert, I've mentioned this, that the cost is $50 right here. And why is it so nice? Because if you are starting new, let's say you start with a small account, let's say you have $2,000 or $1,000 in your account, this allows you to trade options and only spend $50 per trade. You can risk just $50 per trade, and if the trade is successful, you double your money. If the trade is not successful, you cut your losers at 50% loss and you lost only $25. So that makes it really affordable for anybody to trade options. Otherwise, options can get really expensive. So this is a way for small accounts to participate in the stock market using options. Another nice thing about these $1 white spreads is that there is no upper limit. If you, let's say you have a bigger account, you have a $100,000 account, you can, instead of taking one contract, you can take 100 contracts, and now you're risking $5,000. And if the trade goes in your direction, which means if GLD goes by just a few cents and expires there, you will make $5,000 on that trade. So there is no upper limit to scaling up. And obviously, after some point, like I'm not talking about an account going into millions, because then the commissions will start eating into it. But I have I have some accounts which are higher than 6 figures, and I do these 100 contract spreads all the time, and it doesn't affect my profitability. So going back to the chart, so if it expires above 172, you make 100% profit. Now, if we fast forward, so we opened this trade on 10/9, and if you go back to the trade alert, it was opened on 10/9 and the expiration is 11/10. So what you see here is the closing trade alert for GLD. So on 10/27, I was able to close this trade at 94% ROI, although the trade can yield 100% ROI, but I prefer to close it slightly early to avoid exercise or assignment, any such scenarios. So on 10/27, I closed this trade. So let's pull up the chart again, see where is 10/27. So on this day, so I opened the trade here. On this day, I was able to close the trade for my full profit target. Now the expiration was somewhere over here in the future, but I didn't have to wait that long. Because why? Because the stock literally shot up. The day I got into the trade, it just went in my direction. And sometimes, although typically debit spreads will close for your full profit target with 5 to 7 days remaining to expiration. Sometimes when the stock takes off in your direction, I have seen situations where the trade got closed in a week. I mean, that is kind of rare, but it does happen. So the stock could have closed right here too. So it has happened to me in the past, a week, 10 days, 15 days, but I would say 90% of my trades close with 5 to 7 days remaining to expiration. So in this case, obviously the trade was a success. I was able to get out on this day for 94% ROI. And here's the funny thing. Since we are looking at GLD chart and I do swing trading, you may have noticed that the stock is now actually setting up for a bear put spread. So you could make money when the stock goes from oversold to comes out of oversold, or comes out drops below overbought. You can now, this is actually a great time. If GLD drops below this price, I might even take a bear put spread on it. So that's the fun of swing trading, that you can actually make money uh, on both ends of the price movement. Those are the things I consider when opening a call spread. Hope that gives you some insight into my thought process on when I take these trades. So again, the I did make another video on how I take a bear put spread, and I will link that in the description below. And I plan to make more videos like this, basically explaining you the thought process that I go through when finding these trades. Hope that helps.